Hey guys, Michael Garcia here, I See Life. Welcome back to the channel. What I want to talk about today is term term life insurance, right? And quite frankly, if you have not hit retirement yet, I believe term insurance should be in everybody's portfolio. I really believe it's really where you get a lot of value, a lot of coverage for the lowest amount of premium, right? And so I'm going to explain why that's important because ultimately I know people can really fall in love with the idea of permanent life insurance, full life insurance, even IUL insurance, right? While it definitely makes sense to have permanent insurance, one thing you got to understand is when you're designing a policy, you're either going to optimize it for the coverage or for the cash value, right? For the growth, like the flexibility of policy. And so when you're talking about just dollar for dollar cost, you can get a heck of a lot more term coverage for the same price as a whole life policy, right? Your whole life is going to cost a whole lot more. And it just makes sense, right? You got to understand the term policies are really designed just for pure protection, meaning it's there for a certain amount of time, right? So if you started today, let's say you're 35, I run through an example of a 35-year-old female. So let's say a 35-year-old female, she started today at 35 and she had a 30-year term. Those 30 years would pass. She'd reach 65 and then the level term rates would expire, right? Now the contract wouldn't expire. She can continue to renew the contract. However, it would now become an annual renewal term and those rates would skyrocket, typically up 10%, like 8, 10 times the premium, right? So what that does, it's, when people's premium goes from 100 to 1,000 overnight, a lot of people are going to give that policy up, right? And one thing you got to understand is it's not that you can't get a lower cost coverage at that point, but these insurance companies, it's all designed by risk, right? And so what they're doing is they're trying to price you out of that policy and they're forcing you to come back and reapply and requalify because they understand that your health may have changed, right? You're older. And so it's going to cost more to insure you and they want to qualify you for a good rate now, right? They want you to re-qualify. That's where a lot of people could get scared off by term and say, well, I just want whole life coverage or I want permanent coverage because I just don't want it to run out, right? I want it to last. And so with your full life coverage, you're thinking more about permanent death benefit, right? Transferring wealth to your family, making sure that wealth gets transferred. You might be thinking about cash value. And what I'll say is when you're designing a cash value life insurance policy or permanent policy, you have to really decide what that policy is for. Sometimes you'll see agents, they'll talk about it like it's a Swiss Army knife. It's the jack of all trades. It doesn't get your money to perform multiple functions. Yes, right. It could get you a great death benefit and grow your money. But one thing you got to understand is the more death benefit you have, and you want to keep the costs low, right? The more death benefit's going to cost more. So your money's not going to grow as efficiently with a higher death benefit permanent policy. Whereas if you wanted the policy to be for growth, what you want to do is actually strip away a lot of the costs to maximize the growth so more money can go into that cash value and grow over time. So you're actually trying to eliminate coverage when you're growing it for cash value, keep that coverage kind of low, like the cost low with the policy. So one thing I've learned is with these policies, there's an old proverb. It basically says, if you chase two rabbits, you'll catch none. Right. And so the same thing here. If you think you can get the most death benefit and the most cash value, it's just not going to work. Right. Because the more death benefit you add, it's going to affect the cash value, uh, especially in a universal life policy. I've seen some of these policies where, uh, it's minimally funded. And unfortunately, it's just not enough cash value to grow. It's going to lapse, right? In your whole life policies, you are guaranteed as long as you make premiums, just continue to grow. But you're not going to have a lot of cash early on. So what I want to do is show you a comparison All right. So it's going to be for a 35-year-old female. So let's look at the term quotes first, right? So if we look at the term coverage, we did $2 million. And so you want to decide what, what is your coverage for, right? Also, by the way, if you're going to if you want to convert it into permanent coverage, you're going to want to get a convertible term policy with a company that you want to convert it to the permanent policy. So, for example, I like Mass Mutual. I like their whole life. If I want to convert to a Mass Mutual whole life down the road, then I want to get my convert term with Mass Mutual, not with another company, because I want to make sure it can convert to that product. And so you want to think ahead if you're doing a convertible term. But the reason we want to do this, like I said, you want to decide what each policy is for, what the specific goal is. So if we stack all the coverage on this term policy, we know there's no cash value. It's specifically for the death benefit for coverage. If you look at the prices here for 20 years, $102 a month, right? So that would take her to 55. If she were to get a 30-year term, by the way, you can see a lot of the companies, the most competitive companies are here. Banner, AIG, Symetra, Protective, Pacific Life, Principal, right? We're looking at about $182 a month. Whereas if we were to try to get $2 million in a base whole life policy, so here is a whole life policy from Mass Mutual. Now, this is not optimized for cash value. This is just a big base policy for $2 million. If you look at the annual premium here, $1,958 a month, right? Like compared to $182, right? And so this is why, if you're trying to get all the coverage in a proper policy, you're not going to have a lot of flexibility, right? Because that premium is due every single month. Now, can we design this policy that's more flexible and more designed for cash value, especially early on? Yes. Right. And so again, it's what are you trying to get out of each policy? So in this case, we scroll down, you can see in year one, if you look at our cash value, we have zero cash value at the end of year one. We put in 3,500 and we don't have a dime available to us. The second year, we put in another 23,500. So we're at 67,000 and we have access to 2,700. So this policy is not optimized for cash value. It's just a large base whole life coverage. And so you can see the price difference and you can see the value, right? So, if we were designing this for cash, you would have a whole lot more cash value available immediately, right? Depending on how it's structured, you could have 70, 80, even 90% of the cash value, especially like a front load in the policy. You can have a very high percentage of cash value to year one. So you put money in and then most of it is immediately accessible. So obviously that's a very high premium. So the reason why I say, let's make sure that we are using one policy for coverage, right? Let's get the $2 million on a term policy. And if we have the coverage or most of the coverage on that term policy, when we go to design our whole life policy, we don't need as much coverage on the whole life policy. So we can really optimize. Now we can optimize the whole life policy for cash value, for growth, right? For giving some flexibility. So you're not locked into the big block premium, right? We can make your monthly commitment a lot lower, but still give you more cash, especially early on. And so as you're building your wealth, right? If you're a business owner, entrepreneur, real estate investor, you need access to capital, right? You don't want to lock up your money. And so by keeping that flexible and giving you access to the cash value, now you can go grow your wealth, right? And as you grow your wealth, you can now convert, let's say, whatever you designed the whole life policy in premium, maybe it was $1,000 a premium or $1,500 a premium. And now you're max funding that, but you've grown your investment portfolio and you're making more money. Now you could go and you could convert a convertible term policy into additional permanent coverage to give you more places to store your money. And so, um, the key here, like I said, especially if you're a business owner, if you're an entrepreneur, the key here, really for anybody, not just entrepreneurs, but is having money accessible that you can take advantage of opportunity, right? That you can actually grow your wealth and build something, right? And so there's a place for whole life, but there's a place for term. And I think term, like I said, if you're not close to retiring, if you have a large liability and people counting on you, I think term coverage is the best way to get the most coverage, especially when you're looking 15 to 30 years out. Gives you a chance to keep a lot of your money liquid and then actually build your wealth, your company, build your real estate portfolio, build your stock portfolio, and then you can continue to grow and open up additional policies. So yeah, that's why I truly believe you should have a term policy. If you're not at retirement age, you definitely want to get a term. Now, how long should that term be? That's going to be dependent on your outlook, how many years you need it, right? So if you are 30 years from retiring, you might want to get a 30-year term, cover your income. If you're only 15 years from retiring and your kids are older, you might only need a 15-year term, right? Cover some income, maybe cover a mortgage. If you only have, if you have kids, so a lot of the temporary things are covering your income, covering debts, right? Covering a mortgage. There's a payoff date there. And then maybe you want to cover money for your kids' college. Well, if they're 2 years old, you might want to get at least a 25-year term. So that way you're covered 20, so the kids are 27. If something happens, help pay for college. But if they're 15 already, you might only need a 10-year term because in 10 years, they're going to be 25 and out of the house and hopefully done with college by then, right? I never finished college. I went back to school at 30. So it doesn't always work out that way, but at least you know that, hey, while they were young, I did my part in making sure that they were taken care of. I thought ahead and I just wanted to make sure that, hey, in their early years, as they're trying to get established, I was there to help, right? So if you have any questions, how to select a term, like I said, it's not always based on rates, always if you're doing a convertible term, make sure it's the carrier that you want. If you want help selecting a carrier, that's something that we could definitely do. We work like with top rated carriers with strong financials, mutual companies. And so feel free to reach out. Make sure to like and subscribe if you want more content like this. And look forward to talking next time.